Hi there, this is Andy from Totally Forex, and in this video we will go over Forex market basics, such as what is Forex, how does it work, and other key concepts you must know prior trading. So to start, what is Forex trading? Forex or foreign exchange can be explained as a network of buyers and sellers who transfer currency between each other at an agreed price. It is the means by which individual companies and central banks convert one currency into another. If you have ever traveled abroad, for example, then it is likely you had to exchange your currency to the currency of that country, thus you have made a foreign transaction. Currencies are important because they allow us to purchase goods and services locally and across borders. International currencies need to be exchanged to conduct foreign trade and business. If you are living in the United States and you want to buy a car from France, for example, then either you or the company from which you buy the car has to pay the French for the car in euros. This means that the US importer would have to exchange the equivalent value of the US dollars into euros. While a lot of foreign exchange is done for practical purposes such as the ones we just described, the vast majority of currency conversion is executed with the aim of making a profit. The amount of currency converted every day can make price movements of some currencies extremely volatile. It is the volatility that makes Forex so attractive to traders, as it creates a greater chance of high profits, but at the same time increasing the risk. So how does this Forex market work? Unlike stocks, commodities or cryptos, Forex trading does not take place on exchanges but directly between two parties in an over-the-counter market. The Forex market is run by a global network of banks spread across four major Forex trading centers in different time zones: London, New York, Sydney, and Tokyo. Because there is no central location, you can trade Forex 24 hours a day for 5 days a week, with the exception of some holidays. There are three different types of Forex market. The spot Forex market, which is the physical exchange of a currency pair and takes place at the exact point the trade is settled, on the spot or within a short period of time. The forward Forex market, in which a contract is agreed to buy or sell a set amount of a currency at a specified price to be settled at a set date in the future or within a range of future dates. And last, the future Forex market, in which a contract is agreed to buy or sell a set amount of a given currency at a set price and date in the future. Unlike forwards, a futures contract is legally binding. Most traders speculating on Forex prices do not plan to buy the currency itself. Instead, they make exchange rate predictions to take advantage of price movements in the market. Another question that is regularly being asked is, what is a base and quote currency? A base currency is the first currency listed in a Forex pair, while the second currency is called the quote currency. For example, in the Euro versus USD pair, Euro is the base currency and US dollar is the quote currency. Forex trading always involves selling one currency in order to buy another, which is why it is quoted in pairs. The price of a Forex pair is how much one unit of the base currency is worth in the quoted currency. Each currency in the pair is listed as a three-letter code, which tends to be formed of the two letters that stand for the region and one standing for the currency itself. For example, Euro versus USD is a currency pair that involves buying the Euro and selling the US dollar. So in the example, Euro is the base currency and US dollar is the quoted currency as we mentioned earlier. Now, if Euro versus USD is trading as, for example, at 1.11626, then 1 euro is worth $1.11626. If the euro rises against the dollar, then the single euro will be worth more dollars and the pair price will increase. If it drops, the pair's price will decrease. So if you think that the base currency in a pair is likely to strengthen against the quoted currency, you can buy the pair. And vice versa, if you think it will be weakened, you can sell the pair. To keep things in order, most providers split pairs into the following categories: major pairs, which includes 7 currencies that make up 80% of global Forex trading, and those are Euro versus USD, USD versus GPI, GBP versus USD, USD versus CHF, USD versus Canadian, and last, Australian dollar versus US dollar. Minor pairs, which are less frequently traded, often feature major currencies against each other instead of the US dollar. Includes Euro versus GBP, Euro versus CHF, and Euro versus GPI. Third, the exotics, which are a major currency against one from a small or emerging economy. Includes USD versus PLN, which is the Polish zloty, GBP versus MXN, which is the sterling versus the Mexican peso, and Euro versus the CZK, which is the Czech Republic krona. And last, regional pairs, which are the pairs classified by region, such as Scandinavian or Australia, including Euro versus the Norwegian krona and the Australian dollar versus the New Zealand dollar. Thank you for watching our video about Forex and how to trade it. Please like, subscribe, and leave a comment about your experience or questions about Forex.